you could look beyond just treasuries. You can stay in short-term treasuries. If you're in a 2-year, you're earning 5% or so, and you can lock that in for a couple of years. If you want to lock in 5% plus for longer, there are other opportunities. You could look at investment grade corporate bonds, which we've talked about. That yield curve is upward sloping instead of inverted as the treasury curve is. You could look at some, MBS mortgage-backed securities. Those have pretty nice yields. The government-backed ones. So there are some opportunities. And if you're in a really high tax bracket and a high tax state, municipal bonds, although the
Thank you.
nominal yields are pretty low, actually on an after-tax basis for those folks, the yield is pretty attractive.
Kathy, I think about it, how much credit risk I want to take. And I look at the U.S. corporate high yield. It's actually positive return this year, up 1.63% here. Talk just about how you think about the U.S. high yield market.
Well, a little bit cautious on high yield. So the reason it's up is because the coupon's so high. And so if you're clipping that coupon on a regular basis, that's offsetting a lot of price fluctuation. And that's fine. But the spread versus treasuries is of comparable maturity, or even versus investment grade corporate bonds of comparable maturity is pretty narrow. And that means you don't have a lot of cushion if something goes wrong. Now, things have been going right for quite a while, and the risk appetite is still there to buy high yield. But I would allocate, the way to do it is to allocate a small amount to it, not to go overboard. Yeah, 8% looks great, but you don't want to allocate too heavily to it, because when that spread widens, it tends to move pretty fast.
And Kathy, let's talk about the investment grade side of the business. That seems very solid here. And just from the issuance side, we see a lot of companies issuing investment grade debt here. Should our listeners, should our viewers be buying this new issuance here?
Well, we think the market in general in investment grade looks good, whether it's new issuance or whether it's in the secondary market. It just depends on what you're looking for. But yeah, we think they're pretty solid. Corporate balance sheets are pretty good. Corporate profits are just off all-time highs by 0.6% in the last quarter. So clearly corporate profits are good. And the leverage on balance sheets is not excessive. So yeah, I think if you're looking for a relatively high investment grade stream of income, we like that intermediate part of the IG market.
Go back 20 years, Kathy, and I got a lovely trend of great moderation. I'm 3 standard deviations loss there. What is your new sort of coupon total return actuarial assumption of debt? Am I trying to make 7% here over the long term?
I think 7's a little high in that market. I actually look at the current yield around 5 to 5.5%, and so that's a pretty good proxy for the long-term prospects for returns. So I think we're always in the process of updating our capital market assumptions, but I would say certainly in the 5% region is a realistic long-term view.